Hi everybody, it's Kevin Wadsworth, NorthStarBadCharts.com, and it's with a pretty heavy heart today that I'm recording this, and going to run you through some of the charts that we've been looking at over the past few months and years, and making some sense of what's unraveling in front of our eyes. These images that you can see on the screen here take you back to a time where the world changed in many ways, and really, you know, the events that have unfolded over the last 20 odd years since 9/11 have all been interlinked. Of course, the global financial crisis appeared in 2007, 2008. That sort of time, and really everything that has happened over the last 20 years, the global financial crisis and the war on terror and everything else that has happened at home and overseas, of course, is intricately linked, and all of that is shown very clearly on our charts that we look at with our technical chart analysis. I just want to give a shout out to this guy, James Quinn at financialsense.com, for an article that was written back in 2009. You can see it here on marketoracle.co.uk, article 8800. I'd highly recommend that you read this, bearing in mind that it was written well over a decade ago, and it really proved a turning point for myself in beginning to understand the events, how they're linked and where they're leading. And this is something that we very rarely sort of stray into with our charts and our technical analysis, and deliberately steer clear of it. But at times like this, I think it's just common sense in a way to acknowledge everything that is going on in the world, and the fact that the charts that we look at and the breakouts and the breakdowns on the charts are related to these real world events. Now, there's some stuff going on with the charts that has been building for a long time, and I've steered clear of making any dramatic doomsday type predictions and scenarios. But I do think it's probably time to acknowledge some possibilities here. And in doing that last night, I had a little bit of a realization with the US dollar chart that kind of puts things in a new perspective. When people talk about inflation, and particularly hyperinflation, you get funny looks, and people think you're crazy and think that you're some kind of nut job. So let's take a look at the charts and kind of dispel some of that if we can, and look at the evidence. Okay, so this is the silver chart, and I've posted it quite extensively recently, and it's a chart that we're all aware of. But in this context, it's worth thinking again about the fact that this cup and handle that has been building out for 50 years, just pause and think for a second. It's been building for 50 years. So a 50-year pattern like that is probably going to be down here as time goes by. What I mean by that is that for a pattern to be building out for 50 years, if all of this is a build-up, then the reaction is going to be something like that. Now just look on the right hand side of the price scale and pause and think for a moment. This is silver we're talking about, that's currently $25 an ounce. I mean, just look at that chart, ignore the price scale, and ask yourself, does that look unreasonable? Well, no, it doesn't. But then ask yourself the question, what on earth is going to happen to send the price of silver to $100, $200, $300? I don't know about you, but it scares the hell out of me. It really, really does scare the hell out of me. I'm a scientist, and I bury myself in the details and, let's wait for this breakout, let's wait for that breakout, let's see the evidence. On this particular chart, it's a quarterly chart, and to get the evidence that we're going to see a huge move, the price has to break through this Ichimoku cloud, which is pushing up against, and it needs to push through these horizontal resistance levels. That's all technical formality. But then the question arises, well, okay, once it's broken out through there, where is this thing going? What's going to happen with it, given the size of the pattern? Okay, hyperinflation. It's not a theory, it's here and now. Hyperinflation is defined by this chart. This is the UK natural gas futures. This is going to affect every household in the United Kingdom. My personal energy costs from my gas and electricity provider was around about £1,200 a year. Well, I've had it in black and white from my energy providers, and my energy direct debit payments to my bank have increased, and they are going to be £3,000 a year this year. So that's a doubling of my energy costs. And we're now being told that we can expect price rises of 40% or more later on this year. You can pretty much guarantee it'll be a lot more than 40%. So I reckon it could quite reasonably be £5,000 a year or more. Now, that's more than a lot of people pay for the actual cost of their property, certainly in the part of the world, part of the country where I live. So people, think about this for a moment, people will be paying more to heat their homes than to buy the homes. This chart has gone vertical. It's gone from £8. It's gone through all the historic averages. It's broken out above the historic extreme and is now 3 times the historic extreme. Price, having spiked up here, it needed to reverse and come back down in here for this to be something that we don't need to worry about. It hasn't done that. It's built a bullish flag and broken to the upside. That scares the hell out of me. Here we have UK-based electricity futures. It's exactly the same story. We've gone from £24 a therm, I think the unit is. We've passed through all the historic norms of 50 to maybe 70 or 80 pounds a therm. We've gone up to 100, 150, 200, 250, 300. We're sitting now at £323 a therm, or £323 a unit. Just think about that for a moment. The historic price peaks were around about 70 or 80. We're at 323. That's the definition of hyperinflation. Hyperinflation isn't a theory now, it's here, it's now. Oil has moved from, well, technically at one point it was less than $0 a barrel. This is West Texas oil. Now, so far we've passed through all resistance, sliced through this long-term resistance line, and we've moved up from $50, $60 a barrel to the $115 resistance level that I've previously identified. Now, again, this needs to back off and come back down for us to kind of relax a little bit. If it pushes through here, and I see at this point no reason why it won't, we'll be going back to $147 a barrel, guaranteed. And what happens there is anybody's guess. It could hit the $147 level, pause, and perhaps come crashing back down, which is, I guess, what we want to hope for. But if it breaks through $147 a barrel, well, it'll be scary, and the implications will be scary. Germany, the producer price index. This is happening right across Europe. The post-war peak and the PPI was there. The 1970s peak and PPI was here. We're now into unprecedented territory with the producer price index at levels not seen in the last, well, since World War II, since this chart began. And look at the rate that it's gone up at. It's almost vertical. This is the definition of hyperinflation. It's not a theory. It's not in the future. It's now. This is going to hit every one of us across Europe, across the United States, across the world. This is going to shock and destabilize the global financial system in a way that none of us living today has seen. Here we have the PPI in the United States. Look at it from 1913 to now. Notice the two green lines. They're both perfect parabolic curves. So what that means is that the support and the resistance of this pattern is ever increasing. The rate of change is ever increasing. So this line is trending towards a vertical line. And as the price oscillates between these two green lines, as time goes by, and particularly as we get into the mid-2020s and late 2020s, this is going to trend towards an unavoidable vertical move to the upside. And as you move further to the right on this chart, the risk increases all the time that this just does turn into a vertical line straight up and pushes straight through the upper green line. If that happens, I don't even want to think about it. So what I'm trying to say here is that the technical chart analysis, this is another view of the PPI chart, but the previous one says it all. This technical chart analysis is now making me, as a level-headed guy with a scientific background, it's making me really worried and upset, because the inescapable evidence is here in front of our eyes now. This is, or has been, hidden in the background because these movements have been happening in markets that don't affect us straight away, but within, as I wrote on our website a little while ago, and I put a post on Twitter, if this doesn't reverse very quickly, and if these price levels don't reverse very quickly, then it is setting in motion a chain of events that none of us can avoid, and is going to cause global collapse, is probably the word. Collapse of banking systems, collapse of financial systems, collapse of society. I am struggling to find a way, looking at these technical charts, that this can be avoided now. Okay, so back to the US dollar. And those of you who have been following my analysis for years now will know that I've identified this chart. I did identify this chart several years ago as being of significance. It's the domed US dollar chart, and I posted it as with the tagline, "Is the US dollar domed?" Play on words, is the US dollar doomed? And nothing has changed from my initial chart analysis to change the look and feel of the chart. More recently, we've seen a drop in the last couple of years that has reversed to test the edge of the dome in the form of a bearish rising wedge. Those familiar with technical chart analysis will know that bearish rising wedges get that name because eventually they resolve to the downside. I know there's a school of thought that the US dollar is going to go to 100, 120, 150. I'm not going to deny it's a possibility, but the following chart and my realization yesterday makes me feel that that's highly unlikely, and what we're going to see instead is a complete and utter annihilation here, if that's the right word. Maybe it's a little bit too dramatic, but something like this, mirror imaging what happened on the left hand side. So the chart that I want to discuss with you is this one here, and I'll just expand the whole image, and what I want to do is focus on this one in the middle, which is the US dollar index. I'll just minimize the other panes for a moment. And when you see people analyzing the US dollar index, this is the way the chart is normally drawn. with a resistance line from this peak to this peak, showing that what's happened here has been a breakout. And that supports the idea that many people have had. And I should point out here that the scale is a non-log scale. The price has moved in a non-logarithmic fashion. The value of the dollar index has moved in a non-logarithmic fashion. So we're using the non-log scale, which makes the most sense. But this sideways movement looks a bit strange, because following a breakout, you should get a back test and then a move back to, well, the target would be 160. But that's not happened. So I looked at it from another perspective last night, and I said to myself, well, what if, just what if, this is the high for the US dollar, and what if the chart is actually like this? Now, when I did that, it sent a shiver down my spine, because I had a sudden Eureka moment, which caused me to look at the chart in more detail. And the Eureka moment was this. In 1973, the US dollar came off the gold standard. It was March 1973. And at that point, the US dollar was no longer intrinsically linked to the price of gold. Gold was able to float freely in the markets and find its value, true value, which of course it went up by hundreds and hundreds of percent from that point to 1980, where it found its bull market peak. Now, the US dollar was establishing itself as global reserve currency, and the petrodollar was establishing itself in global trade. So that process took place over a period of several years. And in doing that, from a technical chart perspective, it built a wedge. These wedges sometimes resolve to the upside and sometimes resolve to the downside. Underneath this chart, I've got the rate of change. Now, this indicator is really useful. It's set at 84 months. That's 7 years, the 7-year rate of change. And the reason that's useful is because a 5-year trend, when it crosses the zero line and becomes positive, it's a confirming indicator that the breakout is to the upside, or is going to be to the upside. The rate of change was increasing, even though it's hard to tell from the chart itself what's going on. The rate of change was moving ever closer to the zero line, which indicates that the breakout is likely to be to the upside. Of course, that's what happened. So what's so amazing about this? Why did it go, oh my God, Eureka? Well, this is the proverbial beach ball being held under the water. Think about it. For decades, the US dollar hadn't been able to find its place in the world, hadn't established itself against global currencies. So this was the first cycle in a series of cycles that were to unfold. And because the US dollar was suddenly released, it hit its natural target and broke through. You can think of this line as the surface of the water in a swimming pool when a beach ball has been held at the bottom of the pool. The beach ball has so much momentum that it broke out. It's pretty simple theory, pretty simple physics, really, that many technical chart analysts talk about routinely, but haven't applied to the US dollar index chart in this way. I don't think I've seen anybody propose the analysis of the US dollar chart like this and completely, well, not ignore this point here, but have the correct explanation for it. This whole top here was a blow-off top that exceeded its natural limit, somewhere around about 140. So what happened after that? The US dollar index came crashing down, as things do when they've moved parabolically like that. And you'll notice that the cyclical peaks since then haven't been parabolic, which gives even more weight to the theory that this was an unnatural, excessive move to the upside, and that what's happened since is more representative. We formed a bullish descending wedge again through the late 1980s and into the mid 1990s. Watch the rate of change indicator. It was rising. So when this wedge built out here, it broke out, back tested, and took off. And that was confirmed by the rate of change indicator. The US dollar was going to go up. Okay. And then what happened next? Another wedge formed. Okay. The rate of change indicator, whilst the wedge was building, was rising, 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 got to zero. And what did it do? Broke out. So the US dollar index was destined to break to the upside, and it tested that line. So that brings us to today. Another wedge is building out here. You can see it very clearly. And the US dollar index is right up against the upper resistance. But spot the difference. What is the rate of change indicator doing? Now if that doesn't send a shiver down your spine, I don't know what will, because that has to be a huge piece of evidence to show that what's going to happen is that. And that is the US dollar index outlook. In addition to that, this chart that I'm just maximizing now is the US dollar index adjusted for inflation. And again, I've got to thank Patrick for this kind of analysis, Patrick Karim, my colleague at NorthStarBadCharts.com, who has a great way of turning charts on their head and viewing them through a different lens. And as a scientist, that really appeals to me because it lends that weight of evidence to your theory that you need. And whilst you can see on the lower chart that we just looked at a moment ago, the dollar index, sorry if I just move it up, the dollar index has been rising over the last 6 months or more. If you adjust for inflation, and I've done that by putting the dollar index over the producer price index for all commodities in the United States, then you'll see a very different story. The dollar index, in fact, since the 1970s, is just, taking inflation into account, has been doing nothing much really, apart from just going down with, occasionally testing the downtrend channel resistance. So in terms of what the US dollar index is going to do, particularly with regards to inflation, we can look at this in a couple of ways. We can look at the actual chart itself. If I zoom in on the weekly chart, you'll see that we have a technical chart pattern to very much keep an eye on, because this wedge, when it breaks down, and I very much suspect it will break down, there's a gap here and there's a gap here, and some technical chart analysts might point at these gaps and say, well, they're going to be filled. Well, not during runaway inflation, they're not. There's no way. And this is the most logical outcome for the US dollar index versus inflation. I think most of us agree that inflation is going to continue to be a major problem, if not, a problem that's going to challenge, the fabric of society. The rate of change sheds a lot of light on this as well. I'll just move the rate of this. So this is the rate of change analysis for the US dollar index adjusted for inflation. And you can see very clearly, and I'll just put it back on the monthly chart, sorry. So this is the 84 period rate of change that we used earlier on. And it shows very clearly the cyclical nature of this particular chart, and you can see how it's broken down. And the fact that it's broken down below the 0 line, look at the scale on the right hand side, it's below the 0 line, is highly suggestive of this scenario playing out, where the US dollar index adjusted for inflation comes all the way down to this point here, which is a collapse of around about 50%. So, and this applies to currencies around the world. Your purchasing power, taking inflation into account, over the next few months, the next year, perhaps the next 18 months, the time scale is very hard to be certain, but in a relatively short period of time, your purchasing power is going to fall by 50%. And again, pause for a moment and think about that, what that means for house prices, what it means for, more importantly, energy prices, what it means for the price of commodities, what it means for, and a lot of this is going to be focused on commodities, of course, and those commodity costs and producer price costs, input costs, are going to end up straight back with the consumer. A loaf of bread, a bag of rice, a bag of pasta, a bottle of water, all of the essentials of life are about to skyrocket in a way that none of us has experienced before, and the charts are now pretty clear about that. I'm sorry it's such a it's tough to listen to this, and it's tough to read the charts and interpret them and deliver this kind of message, but it is what it is. And I just hope that, well, I'd quite happily be wrong on this. I'm quite happy to be wrong on this. I hope I'm wrong on this, but I just have to tell you what the charts are telling me, and so that you can act accordingly. That's it from me, Kevin Wadsworth at NorthStarBadCharts.com.